We believe that having an active approach in terms of both risk and return is a very key differentiator, because at the end of the day, benchmark itself is a risky asset. So if you want to have good risk-adjusted returns, meaning generating alpha, but doing that in a risk-judicious manner, then you have to be different than the benchmark. I am Aziz Hamzaogullari, the portfolio manager and head of the growth equity strategies at Loomis Sayles. There are 6 key beliefs within our alpha thesis. First and foremost, we believe that having a long-term time horizon is a key competitive advantage in a marketplace that's dominated by myopic investors. We call this time arbitrage, basically focusing on the long term when everyone else is focusing on the short term. We believe the best way to measure this is portfolio turnover. The second key differentiator is high conviction focused portfolios. We believe that the best way to measure that is the number of holdings in a portfolio, and when you look at our portfolio historically, we had between 30 and 40 stocks in our portfolio. Third key differentiator is focus on the quality of the business as a starting point, not the weight of the company in the benchmark. This leads to high active share, meaning a portfolio that is substantially different than the benchmark itself. Fourth, we believe that investing in sustainable, profitable growth businesses compound value over time, and we believe it's very tough to find these businesses because they are rare. Very few businesses actually can attain high growth rates over long periods of time. Fifth, we believe that having a focus on intrinsic value and downside risk is a key differentiator. The best way to measure that, we believe, is to look at the performance in drawdowns or when the market is down. Last but not the least, our focus on absolute risk rather than relative risk is also a key driver for our alpha thesis, and our goal is to focus on the true downside risk or permanent loss of capital rather than tracking error or short-term relative performance vis-a-vis the benchmark. One stock that exemplifies our investment process is Visa, a holding that we had since the IPO of that company. It's a high-quality business with sustainable, durable franchise. It has sustainable and profitable growth, and it's trading at a significant discount to our estimate of intrinsic value. When you look at Visa, the key growth driver is a shift from traditional payment systems like check and cash to electronic payment systems, debit and credit. When we look at that from a long-term perspective, we believe that the penetration rate is so low globally that it will take decades to fulfill that opportunity.